Welcome to Bloomberg ETF IQ. I'm Katie Greifeld.
And I'm Matt Miller. We're watching markets that are little changed. Maybe going through a little bit of a transition right now.
You could say that.
Into a different era. Let's get to the biggest stories right now in the more than $10 trillion global ETF industry. The crypto ETF craze reaches another level with BlackRock filing for an Ether fund and other issuers getting into the race as well.
Plus, it's the third anniversary of Dimensional opening its ETF business. And in just a few moments, we'll speak to co-CEO Gerard O'Reilly about what that's meant for the firm.
All right, and we'll discuss emerging market opportunities, specifically India, with Dina Ting from Franklin Templeton as the group keeps an eye on rates volatility.
And Matt, as always, before we get there, Eric Balchunas from Bloomberg Intelligence, he's here with us now. He's looking at the flows. Eric, what do you got?
Katie, Matt, thank you. I've got good news. The flows are very good, and it's no shocker. November has been a great month for equity markets. And look at the top, right? SPY, VU, and then IVV at 4. I call those the three amigos. Those S&P 500 ETFs represent all investor types, traders and retail. And then, to top it off, you've got JNK and HYG, two junk bond ETFs, also in the top 5. It doesn't get much more bullish than that when you're looking at sentiment and the flows. That said, it's not perfect. Let's look at the outflows. And you hate to see it, at the top is the Qs. If Qs were in that party, I would say it's probably the best flows we've seen all week or all year in terms of 1 week. But the Qs is a little bit of outflows there. But look at the next two, BIL and SHV. Those are both short-term treasury ETFs. Again, people go there to get yield, park cash. They're leaving those and going to equities. So that is net positive. Speaking of net positive, let's take a big step back and look at the flows from mutual funds to ETFs, since we have Dimensional on today. And speaking of transitions, there is a major transition that's been going on for about a decade now from money coming out of mutual funds into ETFs. You can see there's the mutual funds into ETFs. It's very clear. It's not perfect, but net, most of the money is moving there. Depending on who the investors are, it's pretty much a mass movement. So Katie, look, whether it's going to equities or short-term treasuries, it's still going into ETFs.
It's an ETF story, Matt, overall, over the past decade.
Yeah, it seems to have calmed down, though. I think it was hotter last year.
It's been a weird market.
Or at the beginning of this year. All right, Eric, thanks very much for that. Joining our conversation now is Gerard O'Reilly, co-CEO and CIO of Dimensional Fund Advisors. And Gerard, do you see a slowdown in transitions, conversions, I think is probably a better word, because it doesn't feel like we're seeing as many as we were?
Yeah, good to see you again, Matt. In terms of conversions of mutual funds to ETFs, certainly we've had a slowdown on those. We converted our tax-managed mutual funds to ETFs a couple of years ago. And since then, we now have 38 ETFs live in the marketplace as of last week. If you look at the start of the year, we had 30, and of those 30, 21 were already over $1 billion without even 3 years under the belt, and the other 9 were averaging about $500 million. So I think the flows into ETFs, our ETFs in particular, have been strong, and we've been very pleased with the success of the ETF business so far.
And Gerard, let's bring that broader industry story and really focus it on what we're seeing at Dimensional, because as we mentioned, it's your 3-year anniversary of launching ETFs. That ETF business at Dimensional is now about $100 billion. But in that time, you take a look at Dimensional mutual funds, and I believe you're somewhere north of $70 billion worth of outflows. So, I mean, the obvious question here is, are those mutual fund outflows just being cycled into the ETFs, or who is coming into your ETFs?
So I think there's a wide range of folks that use ETFs, and that's what we've seen with our ETFs. We've seen large institutions use our ETFs for their internal trading teams, and that's been kind of an evolution where folks have accepted that traditional active is maybe not the best way to go, and there's been a movement towards indexing. And what we're seeing more now of is people kind of realizing the limitations of an index-based approach and those rigid rules, and moving more towards, I'll call active, transparent, but systematic ETFs. We've also seen broad usage from financial advisors, and that's across all the various different wealth spectrums, from independent to employees of large brokerage firms. They tend to use both mutual funds and ETFs, Katie. They use the mutual funds for the retirement assets, and they often use ETFs in the taxable accounts. So we see pretty good usage of both types of vehicles across the financial advisors that we work with, at least.
One of the things I think you guys ushered in was the low-cost active. Because if you look at all this money going into active ETFs, about 95% of it is going into funds that charge less than 40 basis points, which almost every one of yours does. So whether it's taking an existing investor from a mutual fund, you still have to entice them with something of value. And I think that is crucial. And we've seen other firms like JP Morgan and Capital Group get under that 40 basis point mark. And have you noticed something special about 40 basis points? It does seem to be some kind of a demarcation line for advisors between what they consider expensive and cheap in active.
Our approach, Eric, has always been to look to the market and see, what are market fees and try to be in that bottom couple of deciles of our peer group. And that's what we've done for decades. And so if you look at our weighted average expense ratio across the ETF lineup, it's about 22, I think, when you weight by assets. And that is, again, we're typically kind of in that bottom 2 deciles. And that's been our approach. So 40 hasn't been the hurdle for us or the number for us. It's being in the bottom 2 deciles, so low relative to our peers. And ultimately what we're going for is a set of ideas that are sensible ideas, well implemented at a reasonable price. And that's kind of how we approach the topic with our clients.
How much more can investors put into ETFs and your ETFs? I mean, the growth has been phenomenal for Dimensional. If we go into a recession, does that turn things around, or do you just have products that attract money to those as well?
So fortunately, Matt, the way that we work with financial professionals is that we set the expectations well up front. And what we typically see is that whether we're in a recession or expansion, it doesn't really drive the overall flows of the firm. You can have positive market returns in a recession, you can have positive market returns in an expansion. And understanding what to expect from the market in different types of environments, I think, is the key. And we spend a lot of time up front with the financial professionals that we work with on education and making sure those expectations are well set. So I think there can be many flows going forward into ETFs. Ours are well set up and have plenty of room to take on additional flows from clients.
Well, let's talk about how this breaks down generation by generation, because there was a really interesting survey out by Schwab Asset Management in the past few weeks that found that 89% of millennials that responded to that survey said that ETFs are their investment vehicle of choice. And when you think about new money coming into the asset management landscape, I mean, is that what you're seeing as well, that it's being aimed really at ETFs more so than anything else?
Yes, okay, I'd probably split it up between what's taxable and what's tax advantage or tax deferred. Typically the money, regardless of age, that's coming into 401k accounts is coming into mutual funds because that dominates the landscape there. And typically the money that's coming into taxable accounts or brokerage accounts tends to be into ETFs, and that's what dominates there. Okay, that's one of the reasons that we think that our application for ETF share classes, so that exemptive relief with the SEC is so important, because you have investors, and they're the same investors that invest in mutual funds in their retirement account and in ETFs in their taxable accounts. And we think that it makes sense that you could save for retirement, whether you're 20 or 30, you're going to be saving in a mutual fund these days in your retirement account, and to be able to move to an ETF share class if you choose to roll that over as you retire into an IRA or something similar. So we see it in both sides, Katie, where it's not so much age and it's more related to the type of account, whether it's taxable or tax deferred.
Whenever I tweet out the list of the biggest active ETF issuers, Dimensional is at top with, I think, 95 billion. I inevitably get a couple people who reply with this: well, Dimensional's not really active. And I just wanted to get your take on that, and if you hear that, because these labels matter. Should you be an active, or are you more, say, quant smart beta?
Active, in my view, Eric, has kind of become non-index. If you're not an index, you're active. And Dimensional is definitely non-index because index-based approaches, I think the rules are too rigid. You leave money on the table when you're indexing. So in that sense, we're active, but I would also put in the word repeatable in the sense that we're rules-based, we're systematic, and the process is very, very repeatable. So the results that we've been able to accomplish in the past, you can learn from those and set your expectations about going forward. So I put us in the active camp typically because most of our clients say index or active. There's two groups for them, and we're not index, so therefore we're in the other group. Not the traditional active in terms of stock pickers are forecasting interest rates. but certainly a robust rules-based approach that can deliver outcomes and outperformance versus an index-based approach for clients. And we have decades of track record demonstrating that.
When I read a story like Katie's, and I think a lot of people in Wall Street read about Dimensional's amazing growth, I kind of wonder how you did it. What did it take to hit on this strategy? Why do institutions love your funds? And then I look at your CV and I realize I should be calling you Dr. O'Reilly, right? Because you're a PhD in aeronautics. How does that line of study help you and help Dimensional succeed?
Yeah, I think that, that's kind of at the heart of Dimensional, which is how can you be systematic? How can you be rules-based? And ultimately, I think why Dimensional succeeds as well as it does is because we don't go out try to sell an individual product. We go out with a set of ideas. We go out with a set of ideas that are sensible. We have great implementation. And then we try to come in at a reasonable price point, so a reasonable fee for value. I think that's what we do well. The other piece, though, I would say, is that over the past number of years, which has been kind of wind at our backs, people have realized that traditional active hasn't added value in the way that they had hoped, and indexing has won there. But now folks are realizing that indexing also leaves money on the table. So I think that there's a macro and a micro story here. One is about the performance of our firm, and then another is just a broader trend in the industry, which I think that you're going to see more flows in the ETF landscape to what I'll call systematic active, not your traditional active, both in equity and fixed income. I think you're going to see a lot of that going forward in fixed income for sure.
So maybe you don't have to be a rocket scientist, but he is. Gerard O'Reilly of Dimensional Fund Advisors. Thanks so much for joining us. Coming up, BlackRock expanding its digital asset game to include Ether along with Bitcoin. We'll discuss next. This is ETF IQ on Bloomberg.
I'm Katie Greifeld. Time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with both ends of the yield curve. You're taking a look at long bond ETF flows. You're taking a look at ultra short bond ETF flows. That's in yellow. When you look at the orange long bond, it's already at a record year to date in terms of inflows. The yellow ultra short, not quite there, but we're going to keep an eye on this chart, of course, as we barrel towards the new year. But let's also talk about securitized products. We actually saw two launches last week from the likes of Simplify and Janus Henderson. And overall, if you take a look year to date, 11 of these securitized products have launched. That's not a lot in the grand scheme of things, but it's a lot when you take a look at this specific space. So a quickly growing corner of the ETF industry. But let's also talk about Ether, because we don't even have a spot Bitcoin ETF yet, but last week you saw NASDAQ and BlackRock file for a spot Ether ETF, and that obviously found a lot of excitement when you take a look at the digital asset space. So again, we don't have spot Bitcoin ETF out the door yet, but already groundwork being laid for spot Ether.
Yeah, absolutely. I think it makes sense. Let's talk more about this with James Seyfarth. He is Bloomberg Intelligence partner in crime, I would guess, to Eric Balchunas. Is that the right? What is your actual title? Do you have a?
We don't really have an official title. It'd be an
title?
ETF Research Analyst probably would be the one
I like
to go
it.
with.
All right, so BlackRock is now filing for an Ether ETF as well as a Bitcoin ETF, and I guess other firms are going to pile in, but there aren't too many coins that are as serious as those two, right?
Yeah, I mean, the way we've been looking at it is kind of, Bitcoin is on a pedestal all its own, right? Like that, the SEC is looking at Bitcoin. They've publicly stated it's a commodity. But Bitcoin and Ethereum both have CME futures trading right now, and they have futures ETFs trading.
I see.
So it makes sense that Ether would be the next step. Now, again, we have Bitcoin up here, Ethereum up here, and then it's every other digital asset. We think it's going to be a long time before we see anything else.
20,000 tokens.
Yeah, there's a lot of other stuff out there, but Bitcoin and Ethereum are kind of off on their own side of things here.
Again, we don't even have spot Bitcoin out the door yet, and it's just amazing to see, the next step already being planned for. Can we talk about spot Bitcoin though? What is the current timeline? I know that you and some others have been tweeting about windows. Apparently, we're in one of them in terms of when we could see the 19B4s approved. What's going on?
Yeah, so there's B4. You've got to walk us through that kind of jargon first.
Yeah, 19B4 is basically you file for a rule change proposal and in this case, the rule change proposal is to list Bitcoin ETFs, spot Bitcoin ETFs, and so there's all these deadlines and clocks. But all you really need to know is right now there's a window. There's 12 different spot Bitcoin ETF applications right now out there. There's a window right now where there's no comment periods. There's nothing the SEC has to do in all of them. So theoretically, if they really wanted, they could approve all of them at once. We also don't we're not as tied up on that window. Yes, that's possible, but also, like I said, there's 12 filings. 9 of them, it doesn't matter. Anytime from now to January 10th, they can be approved and theoretically list at some point within that time range. There's 2 processes that need to go on here. There needs to be an S1 approval and a 19B4 approval. 19B4 is the one that everyone's been watching, the one we've been watching closely, and the one that we think is going to happen by January 10th.
I got to ask, as an ETF research analyst, how many women and men do you talk to from institutions who are like, man, I got so many millions waiting to invest in a Bitcoin ETF. They don't want to go through the trouble of buying it. They don't want to custody it. But when it's an ETF, then they're off to the races.
Yeah, so I think there is this whole crypto crowd overhyping of institutions on the sidelines. But it is undoubtedly true that advisors are not buying this yet. There are advisors out there that are waiting for the SEC okay on these assets. They're waiting for a spot ETF. Futures ETFs are a less efficient form of exposure, specifically for long-term investment. So there is an amount of money on the sidelines. It's just maybe not as big, and it's probably going to come in over a longer time period. It's not going to flow in on day one when these things ultimately list, whether or not it happens between now and January.
All right, well, it's going to be fascinating and fun to watch. James, it's always great to talk with you. Our thanks to James Seyffert of Bloomberg Intelligence. Still ahead, we're going to drill down into emerging markets with Dina Ting of Franklin Templeton next. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Matt Miller alongside Katie Greifeld.
And Eric Balchunas from Bloomberg Intelligence back with us now for today's drill down where we focus on one ETF. Eric, take it away.
Katie, thank you very much. Today we have FLIN, which is the Franklin FTSE India ETF. It's our first India ETF on the show, and I'm excited. It's a really interesting area. This is not that complicated. It just buys India stocks, market cap weighted, tracks a general FTSE index. Pretty much what you see is what you get. The big highlight here, and what made this interesting when it launched, is the fee. The expense ratio is 19 basis points. That is really, really cheap. I mean, the next cheapest one is like 65 basis points. So Franklin, quote unquote, vanguarded the India category here. And if you look at the holdings here, the allocations, I want to show you that it generally leans a little financial. When you go into the emerging markets, just generally rule of thumb, you get a little more financials and banks. You can see banks is the top sector, diversified financials, oil and gas. It's not as tech heavy as the US, right? Let's look at the performance of this versus India, which is the big BlackRock one. That's the big dog in the category. And then, of course, VWO, which is the emerging markets broad ETF. So FLIN, to its credit, is outperforming India, which is its real benchmark. And they're both blowing away the broad emerging markets because China and a couple of the countries has just brought this one down. So some people have talked about unbundling it. So Katie, not surprised this thing has $500 million given the returns and that incredibly low fee.
Eric, thank you. And joining us now to talk about this ETF is Dina Ting. She is head of global index portfolio management over at Franklin Templeton. She joins us now, and it's pretty incredible. If you take a look at FLIN, you take a look at the year-to-date inflows, nearly $400 million. That is by far a record for this fund. And when you think about those inflows this year, you think about the outperformance. Are you seeing that EM unbundling impulse that Eric just talked about?
Definitely. We now have the true benefit of single country ETF, right? Because you can definitely unbundle emerging market. As you know, if you look at the broad emerging market, China made up 30 to 40% of the emerging market. That's why the unbundling capability to differentiate, because each of these countries are quite different. India, for example, is experiencing its highest GDP growth with close to 8%. It's probably the highest across emerging market.
What do you expect out of the middle class in India? I mean, in China, it was a story that we covered, constantly, and now they make up 20% of Apple's revenue. Is something like that imminent in India as well?
Yeah, India is quite unique. And the story about middle class, which is very typical to emerging market stories. But beyond that is the geopolitical favorable as well as the demographics within India. So if you look at the industry or like the exposure that you're getting with FLIN, right? You get 200 plus different companies locally. And if you look at the consumer sector, like the consumer discretionary, it is making up a sizable amount of the portfolio. So having that middle class who are getting to expand more into consumer discretionary, whether that's financial services, whether that's insurance, and the fact that they are consuming more, it gives you the benefit of that local consumers, right? Because when you go deeper into the part of the mid cap, you get the better exposure into like the local economy as well.
Dina, back when I covered mutual funds in the late 90s, Franklin was really known as being an emerging markets active manager. That's what I think of still when I think of Franklin. It's interesting you came out with these sort of beta versions, like, again, they're Vanguardian, although they're an area Vanguard would never go. But what about doing active? Do you have any plans to take your active pedigree and introduce it into the ETF wrapper?
We look at active into emerging market as more like active allocation. So being able to use single country ETF allows you to have an active view about where you want to allocate globally. So we believe that overall, the asset allocation will bring more of that active benefits, and being able to allocate into country that you have higher conviction, whether that's India or Mexico, you can use that with our single country ETF. So it's not necessarily that you will get the exposure into individual active within each of the countries.
Dina, great to have you on. Hope we get you back again. Dina Ting there of Franklin Templeton talking to us about FLIN and emerging market investments. Now, if you can't get enough of ETFs, a reminder you can listen to Eric and Joel Weber on Trillions. That's their podcast that comes out fortnightly about the industry. And that does it for Bloomberg ETF IQ. I'm Matt Miller along with Katie Greifeld and Eric Balchunas. This is Bloomberg.